This is the Chris Berry Show. Expert information on wealth, estate, and tax planning for the second half of life. Information that you can understand. Here's your host, Chris Berry.
Welcome to the show. We're going to start the show off, just like every week, with a positive focus, something positive that happened within the previous week, whether it's personal or professionally. A lot of times I'm talking about my kids, but this week I just spent some time actually out of the office and out of Michigan. I was in Topeka, Kansas, doing a refresher on some of the tools that we use when we're helping our clients in terms of managing their investments, wealth management. And so I thought today it would be a great opportunity to just go over that piece of what we call the retirement game plan, creating a sound retirement game plan, and we're going to go over creating your investment plan. So we think there's 5 pieces to any sound retirement plan, and the first part is having an income plan, which is really the foundation for your retirement. So if you look at you're working your whole life and then you move into retirement, you're still going to have expenses, but we need to figure out a way to replace your income utilizing your assets, because you're going from an accumulation phase to now a preservation or distribution phase. And the strategies you utilize when you're creating your income plan or in that distribution phase are going to be different than when you're in an accumulation phase. And then the second piece of it is once you have that income plan in place, then the rest of the assets can be used for investments, for growth. And that's what we're going to spend some time talking on the show today. And then continuing the thought, the 3 other aspects of a sound retirement game plan are having a tax plan. So not just tax preparation, but looking at paying taxes now and in the future. What is the way to structure our investments in such a way that we can minimize taxes? And then the third piece is healthcare. So how are we going to cover our healthcare costs, whether that's health insurance, Medicare premiums, or the devastating cost of long-term care? And we've spent a lot of time on the show talking about different strategies for long-term care planning. And then the 5th aspect of a sound retirement game plan is, of course, legacy planning. So as a practicing attorney, we help our clients put together estate plans, wills and trusts and powers of attorney and that type of thing to ensure that we avoid probate and leave the legacy that we want to. Make sure that the money and assets, whatever's left over, goes where it's supposed to go. So on today's show, we're going to spend some time talking about that, creating that investment plan, which is the second of the 5 pieces of a sound retirement game plan. And really one of the biggest issues with investing is people misunderstanding risk. So one of the tools we have, or diagrams that I use with my clients, is what's called a risk pyramid, where we need to understand that as we move into retirement, we probably should get a little bit more conservative with regards to our investing. And so with risk, the flip side of that is return. So really what we're doing is we're talking about volatility. How much risk are you willing to take on? How much return are you going to get? And different asset classes have different inherent amounts of risk. So talking about that risk pyramid, and I know you're listening to the show and you can't see what I'm talking about, but I'll try to paint a picture for you. So at the bottom of that pyramid are things that you can't lose money in. So things like your checking account, your savings account, not that you're really earning much in those either, but you can't lose your money. Other examples of this would be permanent life insurance, fixed index annuities. Those are all things that you cannot lose your money, okay? Now, the middle of the pyramid, this is going to be things where you can lose some money. So things like exchange-traded funds, mutual funds, variable annuities. These are things that go up and down as the market goes up and down. And you might get a better return, but on the flip side of that, you might also lose some of your money, lose some of your investments. So it's a little bit more risky just based on inherently the type of asset class. And then the top of the pyramid would be things like alternative investments, like Bitcoin, which is all the rage again, it seems like, as well as individual stocks and bonds. And the reason we put individual stocks and bonds at the top of that pyramid is because that if you have all of your investments in say one stock and then all of a sudden that stock goes down, you're going to lose all your money. Remember like an Enron situation. If you had all your money on Enron, well, guess what? Your retirement's looking very different now because you just lost all of your retirement money. So with this risk pyramid, it's important to understand that as you get closer to retirement, you should maybe have more weight in that bottom category, that foundation of the pyramid, versus on the top side. So in terms of the alternatives, typically most of our clients, most retirees have anywhere from 0 to 10% at most at the top of that pyramid. Anything more than that, you're taking on unnecessary risk, most likely. And then the rest should be a mix of kind of the middle pyramid, but probably more weighted towards the bottom of the pyramid. So things that you cannot lose money in, versus having all your money in the market in mutual funds, and then if 2008 happens, well, guess what? Even if you're well diversified, just by having your money in the market in asset class that can go up and down, that can have a dramatic effect on your retirement. And so it's important to calculate your risk tolerance. How much risk are you willing to take on? And then a second piece of risk is risk capacity. So it's one thing, how much can you physically tolerate? And we have a tool we use to assess a risk score. But then the flip side of the coin is how much risk capacity do you really have? For example, if all of your income, all of your assets are going to cover your income gap, covering your expenses, then you don't have much capacity for risk, because if your assets go down, all of a sudden your retirement's going to look a lot different. You're going to have to make cut some costs on expenses, that type of thing. Versus if you have all of your income covered by some of your investments, but then you have, say, 60% left that's not needed for daily income or monthly income, then that would be, you have more capacity to take on more risk in those investments that you're not depending on for retirement. So it's important to understand those two concepts with regards to risk. One is risk tolerance. So for the money that you do have investments, how much risk are you willing to take on? With the understanding that the more risk you take on, the more your potential return. But on the flip side of that, the more you could potentially lose. And then the second piece of it is risk capacity. Just how much capacity do you have to take on risk? Some people might not have much of any. Other people might have a lot of risk capacity. So I think it's important to understand those two distinctions. And it's a really good starting point to understand investing, is how much risk are you willing to take on? How much risk can you physically, how much risk capacity do you really have? And so one of the things that we have, and we walk our clients through this when we're talking about investments, is we help them identify what we call a risk score. So how much risk are you willing to take on? And everyone's risk score can be different, and people might have different risk scores based on when they plan on utilizing their assets. Okay, so if we need money, if we have money that we know that we're going to need this year, then that's probably going to have a different risk score than money that we know that we're not going to touch for 10 years. Because again, the more risk you're willing to take on, the more the potential returns, but the larger the potential loss. So one of the tools we have is a tool to assess a risk score. And we do this on a scale of 1 to 100. And think of it kind of like a speed limit. So the faster you're going, if you're going 90 miles per hour, well, you're going to get to your location pretty darn quick, but there's a chance you might wipe out, right? versus if you're going 20 miles per hour, you're going slow, you're going steady, but you'll get to your destination, but small chance of you wiping out, no big accidents, right? And so what we do is we walk our clients through a few different questions, trying to help them understand and then calculate what their risk score is in terms of their investments. And then once we have a risk score, then what we do is we look at their current portfolio and see if your current portfolio matches your risk score. For example, if your risk score comes out at a 20, but your portfolio is at 80, then chances are you're taking on way more risk than really you'd be comfortable taking on. And while the markets are going good, this could be a good thing because you're getting a bigger return, but when the market makes a change, or if there's a downturn, then obviously that's going to be a tough pill to swallow based on risk tolerance. So one of the things we do is we walk our clients through a few questions to assess what their risk score is, and then we identify if their current portfolio matches their risk score. And then if not, then we look to try to put together a portfolio that is more in line with their risk tolerance. Both their risk tolerance in terms of how much risk they're willing to take on for that return, plus their capacity for risk. And this is probably one of the most important concepts to understand with regards to investing, because everyone's going to have a different risk score. Now, you might have a lower risk score, and then you're out there golfing with your golfing buddy, and he's talking about how well his portfolio is doing and how it's up 20% and everything's going well. And if you have a lower risk score, a portfolio that matches that lower risk score, your portfolio might only be up, say, 10%. And you have to listen to him bragging about what a smart guy he is with this amazing portfolio. But when the market does take a downturn, and the market always goes up and down, it's going to be a very different situation, because most likely he's not going to be bragging about that 30% loss he might have in his portfolio, while your portfolio might be breaking even, maybe above a little bit or maybe below a little bit. Really what we're talking about here is kind of the standard deviation. How wide of a variation are you willing to take on in your portfolio? And that guy at the golfer with the 20% gains, he might be one of those guys that he goes to Vegas and only remembers the wins, not telling anyone about the losses, right? It's similar when it comes to investing. A lot of times people like to brag about all their wins, but they ignore all the times that the market's taking a downturn, or if that hot stock pick didn't really work out. So it's important to have a plan, and it starts with assessing what that risk score is, and then putting together a portfolio that matches the risk tolerance of our clients. And then another important thing to understand with regards to your investment plan is understanding fees. Fees can have a dramatic effect on your portfolio. And I'm not just talking about the fees you're paying an advisor, which anywhere could be from 1 to 2%. But what we're talking about here, not just that part, because that's hopefully your advisor is earning that fee. But we're talking about the hidden fees inside of your portfolio. And this is something that we draw attention to for our clients, is we help them understand the fees inside of their portfolio. For example, mutual funds a lot of times will have fees, because what you're doing is you're basically paying someone to put together a portfolio for you. So inside of that mutual fund is a bunch of different stocks, but understand you're paying someone to put together those stocks inside of that mutual fund. And we call this an expense ratio. So one of the things that we do is we help our clients understand what those expense ratios look like. And then also, one of the things we can get into with our clients is looking at what's called institutional style investing. So think of the big institutions. They're not buying a bunch of mutual funds. They're putting together stock portfolios to match to the risk tolerance that they have. Because if you're purchasing a bunch of different mutual funds, understand that what you're doing is first of all, you're going to have a lot of expenses because you're paying someone to put together these mutual funds for you. But then also one of the big things we see if you have a lot of mutual funds inside of your portfolio is that now you're going to have some overlapping of stocks where you think you're diversified because you have multiple mutual funds, but in reality, each of those mutual funds might have the same stock. Like you might have Amazon stock showing up in all of those different mutual funds. So it's not really as diversified as you may think. And that's something that we help our clients understand is, first of all, the fees that are hidden inside of some of these portfolios. And then also looking at the overlapping stocks. If you do have a bunch of mutual funds inside of your portfolio, they can have there can be a lot of overlap there. And so it's something that we like to draw attention to make sure that our clients truly are diversified. So far, we've talked about investment planning and some of the aspects that make up coming up with a good investment plan. First of all, understanding risk tolerance, and that can be not only risk tolerance, but also risk capacity. How much risk are you willing to take on? And then once we understand that, developing a risk score to analyze whether our current portfolio matches our risk tolerance, and then if not, putting together a portfolio that does match your risk tolerance. And then looking at fees, not just the fees you may be paying an advisor, but also the fees inside of your portfolio. And stick with us as we continue this conversation talking about having a strong investment plan. And then on our third segment today, we'll get into some questions and answers that our listeners have submitted. So stick with us as we continue talking about investment planning.
Certified elder law attorney Chris Berry from the Elder Care Firm in Brighton can help you protect your assets from the cost of long-term care, and they can also help you with estate planning, like they did for Linda Emerson.
I had to redo my will. It weighed on me that I hadn't changed it. I wanted to make everything easy for my daughter whenever I do keel over. But I went in, it was very professional, and sat down with Chris. I would definitely suggest him because he knows his stuff and he's not aggressive. He's, very friendly and makes you feel comfortable because I think he realizes it's not a comfortable thing for people. It was just an easy process. I came out of it and I told my daughter, "It's all yours, kiddo."
Hello, I'm attorney Chris Berry. The Elder Care Firm is here to help you and your family find solutions. Call us today.
Visit theeldercarefirm.com today or call 810-214-3800, 810-214-3800.
And welcome back. So we're talking about investment planning, or developing an investment plan. And we started talking about figuring out what your risk tolerance is. Probably one of the most egregious examples of this is we're putting together a trust for a client, and we were looking at the investments. And when we ran the risk score, and this was for older gentlemen, and in fact, the kids were actually helping to manage the money because at this point he had dementia. But when we were looking at the portfolio that we were going to put inside of the asset protection trust, it was a very aggressive portfolio. And when I brought this to the attention of the family, they're like, "I'm not sure where this is coming from." So the question is, what was the purpose of the investments? Was it to grow and grow grow the assets under management for the advisor, or was it to really truly meet the goals of the client? So it's important to understand risk and risk tolerance and developing that risk score, because that really gives a range of comfort for clients to know that their investments are chances are going to be between this range, and it might be a small range or it might be a very large range depending on how much risk you're willing to take on. And so we talk about risk tolerance and risk capacity, and then we develop that risk score. And then from there, the next step is we talk about fees, helping our clients understand what are the fees associated with different types of mutual funds, different types of portfolios, because that's something that we can manage. Okay, no one can decide or control whether the market's going to go up or down, but we can there are things we can control with regards to our portfolio, and that's managing or at least understanding fees. And I'm not saying that you shouldn't be paying your advisor or that you shouldn't have mutual funds. That's not at all what I'm saying. I'm just saying that you should understand the fees that you're paying. Because a lot of people, they just don't understand how the fees work inside of these mutual funds, and especially egregious are the target funds. So if you're investing in those target funds, a lot of times there's fees on top of fees inside of there. And then the next important thing to understand with developing an investment plan is understanding taxes. Okay, so and this is its own topic in itself, is talking about tax planning, but just understand. When we're talking about investing, understand there's things called long-term capital gains. So we have short-term capital gains and long-term capital gains. Think of it like this. If you have $100,000 and it goes up $10,000, if you wait a year to sell, then that $10,000 may become a long-term capital gain, which is taxed differently and taxed less, if at all, versus ordinary income, where if you were to take that same $100,000, it goes up $10,000, and you sell within the year, then chances are that's going to be taxed at short-term capital gains, which would then be ordinary income. Now, when we're talking inside of an IRA, capital gains really aren't an issue because all of the money, all of the growth grows tax deferred, and you only pay the tax when you pull the money out of that tax deferred account. And that's tax at ordinary income. But what I'm talking about here is inside of your non-qualified funds. So this is money that you've already paid tax on. And it's a taxable account. So this might be like a brokerage account or that type of thing. Or if you just own some stocks in your name, well, we want to try to minimize as much as possible the capital gains on that non-qualified money. Because when you do sell, that could have a taxable impact impact on your taxes on your bottom line. So one of the things that we can do is look at portfolios that are as tax efficient as possible when we're talking about these non-qualified accounts outside of the IRAs. Inside of an IRA, it's not a big deal, but if we're outside of the IRA, one of the things we need to do is manage the taxes, manage those capital gains. And this is especially true because a lot of times we'll set up asset protection trusts, like a castle trust, with the goal of the money that moves into that trust is protected from lawsuits potentially, and also can help be protected against long-term care costs as well. Well, if we're managing this money inside of the trust, then it's important that we also manage the tax impact as well to minimize those capital gains as much as possible. So something to consider with regards to an investment plan is understand where are we doing the investing? Are we doing it inside of a qualified account like an IRA or a Roth or a 401k? Or is it a non-qualified account that may be in your name or in the name of a trust? And it should be invested differently based on how taxes work. So that's something else to consider. Next, I wanted to talk about, with regards to your investment plan, active versus passive management. So there's really kind of two styles of managing assets. One is more of a passive, kind of hands-off type approach, and the other is more of an active, almost a tactical approach with regards to managing investments. And there's pros and cons to both of these. And when we work with our clients, we go over this and we can help them with either route. And we have different money managers that we utilize, including some institutional money managers that manage money for the Apples of the world, the Harvards, the Yales, the Amazons. So now, understand the difference between active versus passive. Passive is more of a let the market do what the market's going to do approach, with understanding that the idea is that you can't really time the market, more of a buy and hold strategy, that if the market's going down tomorrow, chances are it's going to go up in the future. So it's more hands-off. And then with that, the advantage of that is that a lot of times there'll be lower expenses inside of the portfolio. So I was talking about expense ratios earlier. Well, with these more passive approaches, and one of the funds that we like to use that really takes a more passive, more of a hands-off approach, but there is some management. They do look at certain factors that have been proven over time. One of those funds would be dimensional funds, which is probably something you haven't heard of, because they're not spending all their money on sponsoring golf programs or anything like that. They're trying to minimize fees as much as possible, and take more of a hands-off approach to trust the market to do what the market's going to do. So that's one approach, and there's a lot of strength to that. The downside of that type of approach is that the advantage is when the market's going great, it's a really a strong investment strategy. The downside of that is that if the market's volatile or if the market's going down, then a lot of times more of these passive approaches, they're going to get hammered and they're going to underperform. So that's where more of an active or tactical approach sometimes makes more sense, is because now we can take off some of if the market is going down, can kind of nerf it a little bit, put some padding on it, because the money managers will be a little bit more active, getting into timing the market, that type of thing. So if the market is more volatile, then sometimes more of a tactical approach makes sense. If the market's, if we're in a downturn, that tactical approach probably would outperform more of the passive approach. And our firm, we help clients with either one of these strategies. It's really a preference. I have certain biases myself, but it is a preference. But it's all about education. It's all about understanding how these different investment philosophies work and figuring out which approach makes the most sense in your situation. Again, that's active versus a passive investment style. In looking or choosing money managers or funds that take either an active or more of a hands-off or passive approach. Both are viable. Both have their pros and cons. But again, it's important to be just educated on these concepts. And then the last thing I want to talk about with regards to developing an investment plan, which again is one of the 5 pillars to a sound retirement game plan. Those 5 pillars being an investment plan, an income plan, a healthcare plan, a tax plan, and a legacy plan. So the last thing I want to talk about with regards to that investment plan is understanding the role of the person who's giving you advice. And really, this is coming down to what's called suitability versus a true fiduciary. So as a practicing attorney and investment advisor representative, I am a true fiduciary. I have to act in my client's best interest, versus there's a lot of people who hold themselves out as financial professionals that just have a suitability standard. They're not true fiduciaries. Now, you might be asking, well, what's the difference between the two? Well, think of it like this. If you were to walk into a butcher shop, the butcher there is going to sell you meat that's suitable for you, meaning it's not rancid. So yeah, it's suitable for you. Versus the role of a fiduciary, my role would be that more of a dietitian to say, you know what, maybe you shouldn't walk into that butcher shop. Maybe you should go get a salad. Or explained another way is, let's say you go into a store to buy some shoes, right? And so the person helping you, the salesman there, they're going to sell you some shoes that fit you, right? They're going to figure out what your size is, and then they're going to go in the back and grab a pair of shoes for you. Or maybe they might grab a couple pairs of shoes. But we have to look at this for a second. So sure, they're going to pull some shoes that will fit you, but chances are they might pull some shoes that are more expensive, maybe like a $300 pair of boots or something like that. Because where is the incentive? The incentive is on the salesman because he's based on commission, based on how much he sells. He's going to try to sell you the most expensive pair of shoes possible. And then also the incentive is on the store itself to sell the more expensive shoes. So you're walking into a situation where everything is stacked on selling you something that is going to fit you, but it's maybe more expensive than you need. Right? Or look at ordering food at a restaurant. You ask the waiter or waitress, hey, what's good here? Chances are they're going to point to that $50 steak versus pointing to that $20 salad or $15 salad if you're going to a nice steakhouse, right? Because the incentive is for them to try to make money. And the way they make money is by selling the more expensive item, the more expensive product. Well, unfortunately, that's how suitability works. And there's a lot of financial professionals out there that just have a suitability standard versus someone who's a true fiduciary who owes their clients attorney-client relationship. They have to act in the best interest of their clients. So someone who's a true fiduciary cannot discriminate and if let's say product A and product B are both good for you, but product B pays the person 10 times more, the fiduciary, they can't sell product B. They have to sell whatever's in the best interest of the client. So it's a very different approach. And unfortunately, there's a lot of confusion around this idea in the media, in the public. And it's something that if you're not working with me, if you're working with someone else, ask if they're a true fiduciary. And it's kind of frustrating when I see this. I had some clients, they're really like they're a Ameriprise advisor who unfortunately isn't a true fiduciary. And so we're handling other aspects of their planning. We're talking about their legal planning and their tax planning, but they really wanted to continue to have their person manage their investments. But so as we're putting everything together, one of the things that came up with was titling of the assets in the trust. And their quote-unquote advisor said that you shouldn't name the trust as a beneficiary of the IRAs because it's going to be more difficult. There's going to be more taxes on the beneficiaries. And I read this and I replied back to the client that either that's lazy information or that's blatantly wrong. Just because the advisor doesn't want to fill out a couple extra forms, they're now potentially going to miss out on a lifetime of asset protection for their beneficiaries. And then also because they didn't, it's just so frustrating sometimes, some of the advice that I see out there from advisors or professionals who aren't true fiduciaries. So there's a big difference between suitability and a true fiduciary, that fiduciary standard, where you always have to act in the best interest of the client. So it's important to understand when you're getting advice from a professional, are they on the same side of the table as you? Are they making a recommendation that's suitable for you, or is it in your best interest? And it's a big concept to understand. So next time you sit down with your professional, ask them that question. Are they a true fiduciary? Or do they just have a suitability standard? And chances are, if they're hemming and hawing and kind of dancing around it, then they're probably just not a true fiduciary. They might kind of dance around the question or try to make you feel better, but chances are they're not a true fiduciary. Now, I'm not saying they're a bad person or anything like that. I'm just saying that they're not honestly sitting on the same side of the table as you, even if it appears that they are. So it can be a confusing concept. And stick with us as we continue talking about investment planning, getting into your questions and answers.
If you or a loved one is facing long-term care costs, make sure you talk with certified elder law attorney Chris Berry from the Elder Care Firm, like Jennifer did from Howell.
This past summer, my mom had to transition into a nursing home. So we contacted Chris to help get things in order. You know, I wanted the best. I wanted somebody who knew what they were doing. Chris was able to help save a lot of that money that my mom and dad both worked so hard for. I thought that everything would have to go to the nursing home, but it didn't. He was able to save us half of everything that would have gone if we hadn't contacted the Elder Care Firm. And we're all happy about that. Don't go to the nursing home without contacting Chris first.
Hello, I'm attorney Chris Berry. The Elder Care Firm is here to help you and your family find solutions. Call us today.
Protect your assets from probate, long-term care costs, the IRS, and get the governmental benefits you deserve. Visit theeldercarefirm.com today or call 810-214-3800. 810-214-3800.
And welcome back. So we're talking about investment planning as one of the 5 pillars of a sound retirement game plan. Those 5 pillars are having an income plan, making sure your income needs are covered in retirement, the investment plan, having a tax plan, how you're going to manage taxes in retirement, healthcare plan, how are you going to cover Medicare and healthcare costs and long-term care costs, and then, of course, that legacy plan. How are you going to handle that transition of transitioning assets from your name to the next generations in the most efficient way possible, avoiding probate, that type of thing? So with that investment plan, one of the most important things, like we talked about, is understanding your risk tolerance. So how much risk are you willing to take on, as well as your risk capacity? How much capacity do you have for risk? Because you might not have any, or you might have a lot, depending on your assets, net worth, expenses, that type of thing. And then we got into talking about fees and understanding the fees inside of your portfolio. I'm not saying you shouldn't have any fees, but just understand, what are you paying for? Are you paying for advisor? Are you paying for money manager? Are you paying for, do you have expense ratios in your mutual funds? And then if you do have mutual funds, look at those expense ratios, but then also look to see if they're overlapping in stocks. Maybe you think you're diversified, but it turns out that you're heavily weighted to one stock that's showing up in a bunch of your different mutual funds. And then understand capital gains, and especially with regards to your non-qualified accounts. So those are accounts outside of your IRAs and 401ks. Your investment portfolio and your non-qualified accounts you should try to be as tax efficient as possible. And then we talked about understanding the difference between active versus passive money management. Looking at active as more of a technical, tactical approach of managing investments versus more of a passive, hands-off approach. And there's pros and cons to either. And then understanding fiduciary versus suitability. So understanding that I would say a majority of the people that hold themselves out as financial professionals out there just have what's called a suitability standard versus a true fiduciary standard. They're not willing to take the fiduciary oath or go through the training necessary to be a true fiduciary. They might be a good person, might be an honest person, but they're held to a different standard than someone who's a true fiduciary like we are at our firm. So hopefully that's helpful. Get a firm grasp on some of the things to think about with regards to developing that investment plan. Now, what I want to do before we get into some of the questions and answers, and again, if you do have questions, feel free to email us anytime at askchris@thechrisberryshow.com, or you can call us at 810-355-2584. Leave a question, and we'll go ahead and read some of those on the air. Or you can go to our website, thechrisberryshow.com, and there's a spot where you can click through and submit a question. But before I get into those questions and answers, what I wanted to do was talk about our upcoming workshops. So we have workshops that we do about once a week at one of our different locations. And you think summer would be a time that we're slowing down, but in reality, we have quite a few workshops coming up. So in July, we have workshops coming up Wednesday. This is Bloomfield Hills, so our Bloomfield Hills office, which is right on Square Lake between Telegraph and Woodward. So Wednesday, July 24th at 2 p.m., we're going to have our workshop, and we call it a clarity building workshop, where you get some clarity around some of these issues. So that's going to be Wednesday, July 24th, 2 p.m., and then also Tuesday, July 30th at 6 p.m. So those are going to be our Bloomfield Hills workshops in July. We also have some in Brighton as well. So Brighton, July 25th, that's a Thursday. It's going to be one of our evening workshops. That's going to be at 6 p.m. And then Tuesday, July 30th, that's going to be at 10 a.m., and that's at our Brighton office. And then in August, we're going to have workshops in Ann Arbor, as well as Brighton and Livonia. So you can visit our website, thechrisberryshow.com, for a list of our upcoming workshops. Now, what I want to do is get into some of the questions and answers from our listeners. So the first question here is from Betty. And Betty asks, will my family have to pay my estate's taxes when I die? And this is a common question, Betty. So the way it works is in Michigan, it's tied to the federal estate tax. So if you don't have a federal estate tax, you don't have a state estate tax. But basically the way it works is when you pass away, the government takes another swipe of your assets. But they've been nice enough to give us a coupon or exemption amount, meaning as long as we die with less than the exemption amount, we don't owe any estate tax. Well, this year that exemption amount is $11 million, meaning as long as you die with less than $11 million, you're not going to owe any estate tax. And if you're married, that number is actually doubled. So it's actually $22 million. So as long as you pass away with less than $22 million, you're not going to owe any estate taxes. Now, that's estate tax, but understand there's also income tax. And so if you're to leave your beneficiaries with any pre-tax dollars, so think IRAs or 401ks or 403bs, your kids or beneficiaries will have to pay the tax on that at some point. And this is where that Secure Act that we've talked about a couple times now on the show comes into play, is that right now, if you were to receive an IRA, you wouldn't have to pay all the tax at once, but you could stretch it out over your lifetime. So pay a little bit of the tax each year. But if that Secure Act passes, which I think it will, it's going to put a cap, meaning you can only stretch it out up to 10 years, forcing you to pay the tax sooner rather than later, and maybe forcing you to pay more tax as a beneficiary. So you don't have to worry about estate taxes, but you do have to worry about these large pre-tax accounts, large IRAs, 401ks. Next question. This is from Ben. Is an annuity appropriate for me? Is it necessary to have a $200,000 variable annuity? The rationale is that I have no pension otherwise. So as a true fiduciary, I can't answer that, Ben, without knowing more about you, what your goals are, etc. Now, if you were to ask a financial professional who just had a suitability standard and was an annuity salesman, which a lot of these financial professionals are, they'd say, heck yes, you need an annuity. But it really depends. And of the annuities, variable annuities are probably as a whole, and I don't like to pick on specific tools because all it is a tool, probably some of my least favorite investment tools. Because with a variable annuity, what you have is fees wrapped around fees. So with a variable annuity, what it is you're basically paying for mutual funds. So you have these mutual funds, and as we talked about in the previous segment, those have fees associated with them. You can look at the expense ratio of those. So you have fees wrapped around fees because you have these mutual funds that are wrapped in an insurance product that has more fees. So you're doubling up on the fees. And also with a variable annuity, you could potentially lose your money. Now, you might have a variable annuity that says the income is guaranteed to go up each year, but if you're actually looking at the value of the annuity, if you're to take that money out, that's different than the accumulation value, which factors into the income. Typically, if we're looking at annuities, we might look at what's called a fixed index annuity. Much lower in fees and guaranteed to either stay the same or go up based on the guarantees of the insurance company. And also, you can get some of the same benefits with the annuity of guaranteed income. And that's really what the term annuity means, is you can annuitize these products, and now it could be income for the rest of your life. Similar to like Social Security. Social Security is basically an annuity. You paid into it your whole life, and then you flip a switch, and now you get income for the rest of your life. That's kind of how annuities work. So, Ben, without knowing more about your situation, I can't really advise you. Are annuities used as a pension replacement? The answer is yes, sometimes. But I would probably not look at a variable annuity as an option for that unless I had a good reason to. So hopefully that was helpful. Now let's go to this question from William. So William asks, what are some good, safe options to place investment funds? I want to earn more than the bank interest rate when I hold the funds, or while I'm holding the funds in cash. So sounds like he has some cash just sitting there. Kind of, we call that lazy money. It's not going up. It's not going down. We also call that going broke safely and slowly because you're not even keeping up with inflation. And again, without knowing more about your situation, I wouldn't really be able to help you. But there are, and this is kind of getting to that risk score that we discussed previously of, okay, what we have to do is figure out what is your volatility tolerance, what is your risk capacity, and then based on that, then we can talk about some types of investments. Now, you said you want something that's safe, so I'm guessing you'd be probably lower on the volatility tolerance or the risk score. So if we're going 1 to 100, anything above 80 is thought of as aggressive growth. Anything around 20 is thought of more as like capital preservation. So I'm guessing you're lower on that risk score. So there's different things we could look at. We could look at some ETFs, exchange traded funds that are really dealing more with bonds or safer money. But there's different options there. Next question. Can I sell all the holdings in my IRA and keep the cash in my IRA account without tax consequences? And this is from Richard. So it sounds like Richard has an IRA. He has a mix of investments inside of an IRA. And he's asking whether he can sell those investments inside of the IRA and keep everything in cash. Well, the answer to the question is yes, you can. So an IRA, individual retirement account, it's like a wrapper. You can have almost any type of investment inside of that wrapper. So you can have mutual funds or stocks or bonds or annuities all within that wrapper. So if you were to liquidate your investments and keep it in cash, as long as it stays inside of that wrapper, there's actually no tax consequence because it's still inside of your IRA. The issue or the tax you're going to have to worry about is when you pull the money out of that IRA, at that time you're going to have to pay ordinary income tax on that, on top of what other income you have. So yes, you can liquidate your IRA, keep everything sitting in cash. You would have zero tax consequences. The only tax consequence you'd have is when you pull the money out of that IRA. That's when you'd have to pay the taxes. So the next question is from Mike. Can I hold individual stocks in my living trust? Mike asks. Can I hold individual stocks in my living trust? And if so, how do I retitle ownership of a currently owned stock into my trust without triggering a taxable event? My objective of doing this is to arrange my assets, other than my IRA and life insurance, that pass automatically to named beneficiaries so the stock does not have to go through probate upon my death. So, Mike, sounds like you have the right idea here of avoiding probate, and this is obviously getting into that legacy planning. So we want to try to avoid probate, and a trust is a great way to do that. And that's something that we call, or we when we're talking to our clients, we talk about it like building a car. That the trust is like the chassis or the body of the car, and then we need to get things inside of that. We need to drop the financial engine into the right type of car. And now you mentioned a trust. Understand there's different types of trusts. We have revocable living trusts, which avoid probate and control the distribution upon death. And then we also have what's called a castle trust, which is type of asset protection trust that avoids probate, controls the distribution upon death, but now builds in asset protection, protecting you from any lawsuits, and then also protecting you potentially from long-term care costs. So these trusts, they're kind of like a suitcase. You need to make sure that you actually put stuff into the suitcase, otherwise you're just passing an empty suitcase. So with the stocks, Mike, I'd have to know what type of trust is it. Is it a revocable trust or is it an asset protection trust? Because if it's just a revocable trust, then depending on where you have these stocks, you might have it at a brokerage account. You could just change the beneficiary of that brokerage account to now list the trust as a beneficiary. That's not going to have any taxable implications. It's not a taxable event. Or you could change ownership to the trust, whether it's a revocable trust or we always do this when it's an asset protection trust. But the nice thing is, depending on how the trust is set up, typically it's going to be in your Social Security number. So changing ownership should not be a taxable event, should not trigger any taxes. You shouldn't have to worry about any gains or anything because it's still in your Social Security number. Now, there are some types of irrevocable trusts that might not be in your Social Security number. That would be a different story. But from what it sounds like from your question, it sounds like this would be a revocable living trust. It would be in your Social Security number, so there shouldn't be any taxable events happening by changing ownership of that stock. So hopefully that was helpful, and that's it for the questions this week, and that's really it for the show. And if you do have questions, feel free to give us a call anytime at 810-355-2584. You can also call that same number to get more information on our weekly workshops where we get into avoiding probate, long-term care costs, unnecessary taxes, creating your own rule book versus relying on the government's rule book. And we have workshops coming up in Brighton, Bloomfield Hills, Ann Arbor, Livonia, one of our different locations. And you can get more information by going to thechrisberryshow.com, giving us a call at 810-355-2584, or shoot us an email at askchris@thechrisberryshow.com. Take care. Have a great week.
Learn more about Chris Berry and how he can help your family by visiting online at thechrisberryshow.com. That's thechrisberryshow.com. You can also call Chris Berry at 810-355-2584. That's 810-355-2584. This program content reflects the opinions of Chris Berry and his guests, not the elder care firm, AE Wealth Management, or the CJ Berry Group, and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be used or construed as investment or legal advice or a recommendation regarding the purchase or sale of any security or to follow any legal or tax strategy. There is no guarantee that the strategist's statements, opinions, or forecasts provided herein will prove to be correct. Past performance is not a guarantee of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. All investing involves risk, including the potential for loss of principal. There's no guarantee that any investment plan or strategy will be successful. We recommend that you consult with a professional dedicated to your needs. This program is furnished by the Elder Care Firm.
The cost of long-term care can be overwhelming. If you're dealing with long-term care costs, make plans to attend the next free informative workshop from the Elder Care Firm in Brighton. They'll show you how to protect your hard-earned assets and obtain the governmental benefits you deserve, including veterans benefits and Medicaid.
Hello, I'm attorney Chris Berry. As the only certified elder law attorney in Livingston County, I have the knowledge and estate planning strategies to help you. When you call, reserve your seat at our next workshop or schedule a free 15-minute phone consultation. The Elder Care Firm is here to help you and your family find solutions. Call us today.
Spots are filling up for the next free Elder Care Firm workshop. Reserve your seat today by calling 810-214-3800 or visit theeldercarefirm.com. The Elder Care Firm also invites you to join them at this year's Walk to End Alzheimer's. The walk is on Saturday, October 1st in downtown Brighton. Call 810-214-3800 today.